Today we're buying more PTY, Pimco Bond Fund. It's a 5-star fund on Morningstar, and we make about $98,000 per year. We want to increase that every day. So let's go into a chart of PTY, and you'll see here that it's way off of the highs. The highs it originally set were at 16. Now the stock is at 13. Well, actually, you can see here on the 5-year chart, the original highs were 20. So within the year it was 16, but long-term 20 is what you're seeing as the old highs. A few times it hit it back in 2018, 2019, 2020. So 20 is the old high, and these lows of around 10 to 12 are the historical ranges for the lows. So obviously we're going to add to this fund if it's a 5-star fund and it pays an 11% dividend. So let's do a little bit more research on Pimco before we make the buy. So Pimco, once again, it's a 5-star fund on Morningstar. $10,000 invested 10 years ago made you about $30,000. So we prefer other funds that we've been making videos on, like USA and Cornerstone, because they made much more than this, but you still want to have diversification into bonds. Bonds are always safe, and you need to have some of that safety in your portfolio to minimize volatility. So here's what Pimco does. It has mainly corporate bonds, so it's not like risky business development companies yields that it gets its interest from, or junk bonds. It's corporate bonds. Healthcare, they have about 8% in healthcare, banks 7%, technology 7%, so pretty balanced throughout. And they have a maturity percentage of 0 to 1 years is 15%. So this is you want to stay away from funds that have too much duration. But interest rates are rising, but interest rates are already seeing most of their rise. So the maturity and the duration lengths of some of these holdings in the fund don't matter to me, especially with how cheap the fund is. Being at all-time lows historically. So also we have leverage. It uses 34% in leverage. So it does see some extra drawdown when prices move down because it's leverage. But on the flip side, it'll see some increased movement to the upside because prices are leveraged. So we want to make sure we buy 1,000 of this before the market opens so that I don't forget. And the market is rising today on the heels of a positive durable goods report, which came in above expectations. Durable good orders fell, excuse me, which is good for inflation. So we're going to buy 1,000 PTY just to get it in before the bell. So again, durable good orders fell. Why we only buy 1,000 of PTY? Because we already have 14,000 of it. So as you can see, PTY. Actually, what do we have? We have 8,500 in it. So I'd like to actually get that number up to a little over 10,000. So let's change that order to 1,500 to make it an even 10,000 that we're going to have in it, and to make everything worth our while. So we're also buying DVY in the pre-market. Excuse me, as we said in the last video. Well, we believe in we believe in DVY. Just not something that you should put all of your money in. So let's do 100 shares, 125 shares. Make it 115. Okay, that's about $1,500. Buy, preview, place. Okay, so we have PTY in now. We're buying some DVY. We're underweight DVY though because the sectors that are in DVY are mostly consumer, staples and defensives, and those had their run last year, so we're trying to get more aggressive into things that are cheap this year, like bonds and growth. So here's the market open. Okay, it's 8:30, so we're up 6,500 to start the day. We don't care about this number as we maintain. We only care about 1% is what we're up with the market. Let's see what the market's up. Look up top. The Dow, let's refresh it. The Dow is up 0.66, the Nasdaq's up 1.7, and the S&P is up 0.8. See, Dow down up 0.6, Nasdaq 1.07, S&P up 0.8. We're up 1.17. This is what you want to see. $7,000. We're also, you saw that we're up, we earned about 98.5 per year. Let's see what this new purchase of PTY puts us at. It puts us at 98.7. So we're gradually growing our income off of all these monthly dividends paid to us. Now, one more reason why we added a PTY is because a lot of people are saying interest rates are going to 6. Well, if interest rates are going to 6, how come bonds haven't priced that in already? The market's forward-looking 12 months. Why haven't bonds been sold off now to where the prices drop and the yields hover north of 6%? Why isn't that happening when the market's 12 months forward-looking? It would have happened by now if people really thought the Fed was going to be that aggressive in hiking rates. But people are seeing that inflation is falling. So why would the Fed hike rates as much? Plus, they did most of their hiking last year. So this year they have a few more hikes to go, but we've already priced that in last year. And also look at the prices of these funds. Like I just showed you, PTY is at a historical low and it's a 5-star fund. So inflation's falling. Again, you saw the durable goods number today. You saw Walmart's number last week where they made a nice profit, beating expectations because they took their medicine and discounted all of their high-priced inventory. So durable goods, those hard orders like transportation coming out and even high-priced electronics, those have been cut in price as companies are trying to remove their inventory from their books. And this is deflationary as they have to lower prices to do so. So last, I want to say that a lot of bears are coming out right now saying that you shouldn't, buy funds or buy certain stocks or the indexes because the market is terrible and it's looking like we're heading into another bear market or something. But they claim to still make the same argument that certain stocks will work. I've said this before in previous videos. How can certain stocks like today on CNBC, people are recommending Arista Networks, Palo Alto, Google, Salesforce, a lot of these are tech, and they're like, well, but these tech stocks will survive. Well, most of these tech stocks are the index of the NASDAQ. So if the NASDAQ holdings are going to move up, then why would the NASDAQ itself move down? Yeah, I get that there's some other names, maybe in the Cathie Wood ARK funds that aren't as profitable, but those are not in the indexes. So if the Cathie Woods funds are not in the indexes, why would they think that the index can't move up from these companies that they're listing, which are in the NASDAQ? It just doesn't make any sense. The bears keep saying it's a stock picker's market. They keep saying that companies can't make money right now. They're just engineering their EPS by not beating on the top line, only beating on the bottom line as they fire workers and cut costs. But I saw this same trend in 2012 when everyone thought that the market couldn't move higher because nobody was making real money. They were just firing people and raising their dividends and increasing their buybacks on their shares. Well, this all creates a positive earnings per share environment, which makes the PE multiples drop of the companies, increases their earnings per share, makes their PE multiple drop, which makes them look cheaper in the long term. So you have to buy them now. Plus, the market is 20% off the highs. So we've been doing videos also on the SPY and how, looking at signs of a bottom. We've done a past video on that. And, you need to understand that the S&P has pulled back and it's looking like it's at a decent entry point, as you can see at this chart below. This is the triple though. So let's look at the single so we don't get any skewed data because leverage skews data. So we're here at the S&P. We broke below that 100-day moving average last week, but we held above it. And I said this in videos that we could break below the 200, the orange line, and the 100, the blue line, but we hold it and we hug it. And the odds that we retest 380 are small, but if we do retest 380, which is this consolidating pattern right here, this base, then we should hold 380 because, again, the Fed has done a bulk of its rate raising. Companies are still making money. Stocks are cheap. They're way off the highs. Look at the S&P. Not only did we break support, but we're holding it. But look at it on a 10-year chart. You'll see that it's between 10 and 20% off the highs. It was originally more than 20% off the highs. The NASDAQ fell 30%. But this is a decent entry point for the S&P. I mean, look at the RSI on a total basis. The RSI, when it reaches this level here, this level, bottom with the stock market. So when the RSI bottoms, the SPY bottoms above. Excuse me. We have another RSI tag here of 40. Okay, 40. Every time it tags 40, 40, and 40. Every time it tags 40, you see a corresponding uptrend in the market. So 40, 40. Now we're here at 40 again. So you're supposed to buy these dips when the RSI is at 40. Look historically, it's very cheap on a 10-year. Let's look at it on a max chart just for clear perspective. And again, you didn't get the puke out here to the gray area of oversold like we did in the dot-com bubble or in the '08 crash. But those are unprecedented times. We still made it, though, to the 40s, which historically in the past, again, that was a good entry point. And that marked a bottom in the stock market. So we're basing here as well. You could easily see this, creep back to even old highs by the end of the year. This is a pretty bullish pattern, but I could also see it falling, a few more percentage points from here back to the old lows of, like I said, around 380. But we've already been through that. Last year we went through that. Okay, most people make this argument of, why not just buy now? The market's going to make it to new highs. As you saw on that chart, it always goes up to new highs. So when you just buy when you're 10 to 20% off the highs, period. You buy when things are cheap, period. Even if it looks messy, even if it seems wrong. The last thing I wanted to say was that people are buying VIX calls now, thinking that there's going to be an increase in volatility. Well, when everyone's saying to do something, that's when you go the opposite of the street. So everyone's fearful. That's what the VIX measures is fear buying, put buying, which is a measure of fear. When everyone's fearful, you buy. So when I see that people are all increasing their VIX exposure, you can't go with the herd. The herd always loses. And whatever the herd does, you're supposed to go opposite. So, and we've already felt all that pain. If you couldn't shake us out of last year with the Ukraine war, China issues, inflation, and interest rate hikes, and we couldn't break that 380 barrier for long that I showed you, because we tagged that 380 barrier multiple times. If we couldn't get through that 380 barrier with all of last year's fear, do you think this year's fear of less interest rates being raised, less interest rate hikes than last year, corporate profits stabilizing, employment is strong. We've had the strongest employment in our history. So how would this year mark the year of more fear and therefore more VIX buying, and therefore you shouldn't buy stocks and funds now? Look, we're up 19% for the year. The S&P's up 3%, the Nasdaq's up 8%. Anytime the market's down 20%, you buy, because over time it will make it to new highs as the market averages 7% a year. So we added to PTY today. We have 10,000 in PTY. I'm proud of that buy because it wasn't too high above our cost position at 2%. You don't want to buy when you're too far above the cost basis. You want to manage risk. I'm proud of that because it has an 11% yield and it's a 5-star fund. Our debt is now $225,000 approximately. It has risen, but we have 5,000 in shorts, and we've added to some things during the market weakness that we said we would do when the market fell. We said we would be buying all the dips, and we have to do this as long as our interest on our margin of 5% is viable enough to where when we buy something like PTY, it makes a profit for us. And PTY at 11% yield minus our margin rate of 5%, we're netting about 6% to do this. So plus the prices are cheap for PTY. So you're going to get the best of both worlds. The capital gains appreciation as it moves back to its old highs from around 12 to 20. And you're going to get the 10% dividend yearly. So paid monthly, like a paycheck. So this is what we're doing. We added to PTY today. Don't be worried about interest rates going to 6. Even if they do go to 6 from here, that's still kind of already priced in. And historically, interest rates between 5 and 6% are low. So you just buy the market when it's down 10 or 20%, period. Don't worry about the VIX calls buying. People who are all fearful are usually wrong, and you're supposed to go counter trend to people who are fearful. If bond prices were supposed to go to 6, why haven't they priced that in now? So you just buy now when stocks are 20% off the highs. Look at inflation falling. Look at durable goods orders. Look at oil prices at the pump. Look at your housing prices. Everything is falling. But yet people will just say, hey, stay away from this market. Don't buy yet. Just be a stock picker. Buy certain selective things. Well, if you do that, you have to put all your money behind it to make a difference. And then you could lose, as one stock could always go broke from headline news. So you buy the indexes. That's what all these investments are tied to, are the indexes and bonds. And that's how you ensure the performance that we got above, which is 20%, whereas the market's up 3%. So, and you use this leverage to maximize your performance and income. So anyway, hope you like the buys in PTY. Even if we're wrong, 10% times 10 years, it cash flows, and we're near the low. So it's a low risk reward entry. Stay tuned for more videos. Thank you.